of international financial management, that is international monetary system. Before discussing international monetary system, let me first tell you the learning objective of my class. After completing the class, you can know the meaning and scope of IMS or international monetary system. You can know the exchange rate arrangement. The exchange rate arrangement will be discussed in pre-IMF period and post-IMF period. We will have some knowledge regarding some of the exchange rate standards like commodity specific standard, gold standard, IMF fixed parity system, IMF and international liquidity. All these concepts will be discussed in our class today. Next, we will discuss first what will be the structure of my discussion. First, I will give an introduction to IFM. Next, we will discuss exchange rate arrangement. Next, we will discuss evolution of IMF. Then the present system of IMF and international liquidity. Then we will summarize our discussion. Then self-assessment question, further reading. This will be the structure of my discussion today. First, let me tell you what is IMF or IMS. What is IMS? IMS simply means International Monetary System. It refers to the system and rules that govern the use and exchange of money around the world between countries. What is IMS? IMS is the system and rules that govern use and exchange of money around the world between countries. You know, in case of international business, the most important thing is payment, international payment systems. How the transactions will be settled between two countries. Which currency, in which currency, and if the currency is decided, what will be the mode of exchange, what will be the medium of exchange, and the rules, regulations regarding exchange of money between different countries is known as IMS or International Monetary System. So IMS refers to institutional norms and the entire environment that facilitates settlement of international payment. So IMS is all about the rules, regulations, environment that facilitate the settlement of international payment. International payment means payment between two countries. Let's take an example. Suppose you import from US. You have to make payment in US dollar. So once you want to make payment in US dollar, you will convert your Indian rupee to US dollar. In what rate you will convert? What is the mode of exchange? What is the medium of exchange? What are the rules, regulations regarding those conversion as discussed under International Monetary System? Okay, so in common term, exchange rate settlement is known as International Monetary System. Okay, so exchange rate play a vital role in settlement of international payments. We know that exchange rate play a vital role in settlement of international payments, and the rules, regulations regarding the international payments are discussed under IMS or International Monetary System. Next, we will discuss what are the key elements of IMS. Key elements of IMS. The key elements of IMS are as follows. First, it deals with exchange arrangements or exchange rates. It deals with international payments. It deals with international capital movements. What is international capital movement? Movement of capital from one country to another. Like FDI, FPI, all these rules, regulations are governed under IMS or International Monetary System. It deals with international reserves. Every country maintains certain forex reserve, and in which way they have to maintain the reserves are decided under IMS or International Monetary System. Hence, IMS we have discussed in context of MNCs IMS plays a vital role. So IMS is the overall environment in which MNCs operate. So we know that in an international business, the most important thing is payment settlement. The payment settlement are to be done between two countries or two parties in two different countries. There must be a common currency in which settlement is to be made. So there must be an exchange rate, and the exchange rate is to be decided by certain framework, rules, regulations, and there will be international exchange of funds. The international exchange of funds are to be settled as per certain rules, regulations, and all these things are covered under international monetary system. So we can conclude international monetary system is the institutional framework within international payments, within which international payments are made and movements of capital are accommodated and exchange rate among countries are determined. So this is the most acceptable definition of international monetary system. Next, we will discuss evolution of international monetary system. What is evolution of international monetary system? What was the how the international monetary system is evolved over the period of time? We know that previously international trade is going on for centuries. Previously, the currencies of different countries were made in metals. So, metal means gold or silver. So, the gold content or silver content of each currency decide the exchange rate. Okay, this system is followed in the world before 1875, and this system is known as bimetallism system. So previously the international trade was done through bimetallism system before 1875. Thereafter, many more systems evolved for settlement of international transactions, and these are known as evolution of international monetary system. What are the evolution of international monetary system? We can study the evolution in different stages. What are the stages of evolution? The first stage is known as bimetallism. What I have discussed, it existed in the world in before 1875. Then there is a extension of bimetallism that is known as classical gold standard. The classical gold standard exists in the world from 1875 to 1940. Then comes interwar period. Interwar period, it existed between 1935 to 1944. Next comes a system that is known as Bretton Woods system of exchange rate. It exists in the world from 1945 to 1972, and currently the system is known as flexible exchange rate system, which exists in the world from 1973 onwards. So we will discuss each of it separately. First, we will discuss regarding bimetallism. Then we will go for classical gold standard. Next, how exchange rate was decided in interwar period. Next, we will focus our discussion upon Bretton Woods system of exchange rate, and at last we will discuss regarding flexible exchange rate regimes which exist in the world from 1973 onwards. The first standard is known as bimetallism, that is also known as commodity species standard. Commodity species standard or bimetallism. What is commodity species standard or bimetallism? We know that before 1875 the currencies were made in metals. What are the metals? Metals were gold and silver. At that time currencies were in form of gold coin or silver coin, and a particular ratio is fixed between gold coin and silver coin. That ratio is known as mint ratio. Mint ratio means one gold coin is equal to how much silver coin. That is known as mint ratio. In France, the mint ratio was 15.5:1. It means one Francis gold coin is equal to 15.5 Francis silver coin. Okay, and this was existed in 19th century. So the coins which were made there were of two types. One is known as full bodied coin. What is full bodied coin? In case of full bodied coin, the face value of the coin and the metal value of the coin are same. That is known as full bodied coin. Face value of the coin is equal to metal used in the coin. But there can be debased coin. What is debased coin? In case of debased coin, the face value of the coin is normally more than the metals used in the coin. That is known as debased coin. So how in that situation exchange rate was decided? And this is known as bimetallism. Under commodity species standard, the exchange rate is decided under a system that is known as bimetallism, and it existed in the world before 1870s. And in this case, the exchange rate is decided as the gold content or silver content of each currency. That is known as, on the basis of gold content and silver content, the exchange rate is decided. Suppose, example, a dollar contains 20 ounce gold, $1. Similarly, 1 rupee contains 10 ounce gold. So what will be the exchange rate? Exchange rate will be $1 is equal to 20 ounce gold by 10 ounce gold, that is equal to 2 rupees. On the basis of gold content of the coin, the exchange rate is decided, and this type of determination of exchange rate is known as bimetallism. Bimetallism, and this bimetallism exists before 1870. Bimetallism. Okay, and after that, a sophisticated version of bimetallism exists, and that sophisticated version of bimetallism is known as classical gold standard. So second one is classical gold standard. It is an extension of bimetallism. At this period, and this is existed from 1816 in case of England. Now, and it existed from 1878 in France, from 1875 in Germany, in 1879 in WE, in 1879 in Russia, 1897 in Japan. They adopted gold standard. So what is gold standard? Gold standard is an extension of which standard? Commodity species standard or the bimetallism. In this case, the currencies are made both in gold as well as in paper currencies, and the papers are made from gold papers. Okay, so the gold papers do not have that value, but what happens? The central bank of a country gives guarantee to convert the gold paper into gold at a particular predetermined rate. So in this case, the coins were made in gold, but the currencies were made in gold paper, and the currency is freely transferable, and freely transferable into gold by the central bank at a stable ratio, and this ratio is decided by the central bank of the country. And in this case, gold is freely imported and freely exported between countries. You can import any amount of gold or you can export any amount of gold. So under gold standard, import and exports results in inflow and outflow of gold. So we will discuss regarding gold standard more. So gold standard has three important forms. What are the three important forms of gold standard? First form is gold species standard. Second form is gold bullion standard. And the third one is gold exchange standard. So there are three forms of gold standard. First one is gold species standard. Second one is gold bullion standard. Third one is gold exchange standard. So what is gold species standard? In this case, the coins were minted of gold. Okay, coins were in gold, and the paper currency could be converted into gold on demand at a price fixed by the law. That means in this case the coins were made of gold and the paper currency was also there, but the paper currency could be converted into gold at any time if you demand to the central bank at a rate which is prefixed by the law. This is known as gold species standard. Then there is some countries followed gold bullion standard. What is gold bullion standard? In this case, there is no compulsion to mint gold coin. Gold coin was not there, but paper currency was not convertible into gold on demand. Paper currency was not convertible into gold. Gold coin was not there. Paper currency was there, but it is not convertible into gold on demand. But there is a catch there. In this case, there is another thing which is used, that is known as gold bar, and the gold bar could be purchased from central bank at a fixed price, and it can be sold to central bank at a fixed price. So in this case, paper currency was there, gold bar was there. Gold bar could be purchased and sold to central bank at a fixed price. So if you have a huge amount of paper currency, you can take this paper currency to the central bank and convert it into gold bar, not gold coin. You can convert it into gold bar. You can purchase gold bar. The third system was gold exchange standard. So what is gold exchange standard? There is no compulsion to mint coins. Coins was not there. Paper currency was not convertible into gold. Paper currency cannot be converted into gold by demand, or central bank there was no way outright to convert it to gold. इसका मतलब in this case there is no concept of gold bar. So how the currency will be converted into gold? The currency is not converted into gold, but currency will be converted into another currency which can be converted into gold. That means in this case the currency can be converted into currency having gold specific standard, and this was convertible into gold. For example, ruble was a currency. Ruble cannot be directly converted into gold by the central bank, but ruble can be converted into British pound at a fixed rate, and you can convert your ruble into British pound, and you can convert the British pound into gold. This is known as third standard, that is gold exchange standard. Under gold exchange standard, the currency can be converted into gold with the help of a third currency. This is gold specific standard. Okay, in case of gold standard, there were three important rules, that is three important mechanism. One is fixed exchange rate. The exchange rate was fixed, and there is adjustable in balance of payments. You can adjust the BOP with the help of this, and there is domestic price stability. These are three important advantages of gold standard. So in case of gold standard, the central bank gives guarantee that the currency will be converted into gold. So this system lasted in the world for 30-40 years. Then there comes the World War. During time of World War, what happens? The countries required huge sum of money. So they want to print more and more money. But under gold standard, you cannot print money unless you have backing of gold. If you do not have gold, people will come to convert the money into gold when a country cannot convert the money into gold. So huge amount of money is required to finance the war. So at that time, if you the central bank gives guarantee to convert the money to gold, that much of money could not be printed. Therefore, most of the countries set back the gold standard. They leave the gold standard. Okay, so they do not give backing of gold for the currency. They do not give 100% backing of gold to the currency. Great Britain, France, Germany, Russia, they abolished the gold standard. Okay, so to finance the war expenses. But once the war was over, again these currencies, these countries shifted to gold standard. UK shifted to gold standard again in 1925, and in 1928 France. So they have restored the gold standard again. Okay. But during the time of World War, many things have changed in the world. What are the things which have changed in the world? So, the things which have changed in the world were the international economic scenario has changed. Germany and Austria were in grip of hyperinflation. Pound was overvalued. France devalued its currency, and most of the countries followed expansionary monetary policy. What is expansionary monetary policy? They want to print much and much more. They want to increase the money supply in the economy. So next there is comes the Great Depression of 1930s. Lord Keynes, the Keynes economist, he has given the formula to tackle the depression. That means you have to increase the money supply. So the gold standard in interwar periods have failed to fit the changed international economic scenario. Finally, the gold standard was abandoned. UK again abandoned gold standard in 1931. US abandoned in 1933. France left the gold standard in 1936. Next comes the setting of one institution which will see the international payment system. That institution is known as IMF. After the close of World War II, in USA there is a place called New Hampshire, and hotel is Bretton Woods. And in that Bretton Woods hotel in New Hampshire, the economists of the world sit together and they decide a system of exchange rate. That system of exchange rate is known as Bretton Woods system of exchange rate, and in that conference they have decided to set up one institution which will look after the international monetary system, and that institution is known as IMF. In Bretton Woods system, two institutions frame. Those two institutions are known as twin child of Bretton Woods Conference. What are the twin child of Bretton Woods Conference? The twin child of Bretton Woods Conference was IMF and World Bank. A World Bank at that time is known as IBRD, which is known as World Bank. So in Bretton Woods system, they have set up two institutions. One is IMF and IBRD. IBRD was set up to finance developmental project, to finance developmental projects. And IMF was set up. Why IMF was set up? IMF was set up to provide loan for BOP crisis. If a country faces BOP crisis, IMF will make payment to him. BOP crisis means balance of payment crisis. But means that country do not have abundant foreign currency to make payments. That is known as. So IMF was set up in Bretton Woods Conference, and in Bretton Woods Conference, one exchange rate system was developed. That system is known as Bretton Woods system. Now we will discuss the broad features of Bretton Woods system. Bretton Woods exchange rate. Bretton Woods system exchange rate. What is the Bretton Woods system exchange rate? We will discuss. First, in this system, fixed parity system was followed. What is fixed parity system? Exchange rate was fixed, and each country want to set up the exchange rate at a fixed value, either to gold or to US dollar. What happens in this system? The countries are asked to fix the exchange rate at a constant rate, either to gold or to US dollar. That means at this system, after this system, the international settlement could be made either in gold or in US dollar. And US dollar is equivalent to gold. Why US dollar is equivalent to gold? US Central Bank Fed Reserve gives guarantee to convert the dollar to gold at a fixed rate. That rate is $1 is equal to 35 ounce of gold. That means anyone who will bring $1 to the Central Bank of USA will Central Bank will give him 35 ounce. Okay, 1 ounce of gold was $35. 1 ounce of gold was $35. That means $35, I will give you 1 ounce of gold. That is known as Bretton Woods system. In this system, what happens? Each country fix their exchange rate either to gold or to US dollar. US Central Bank gives guarantee to convert $35 into 1 ounce of gold. Okay. Now this system was prevalent in the world for next 20-25 years. Okay, but certain things happened during this period, and this system performed well in 1940s till 1950s. But what happens during this period? US dollar did do well as an intervention currency. US dollar is treated as good as gold. But what happens during this period? US is facing huge deficit with other countries. Huge deficit, huge trade deficit with other countries. The US balance of payment began experiencing growing deficit on widening trade deficit. If there will be trade deficit, there will be outflow of dollar. That means outside USA, there were many dollars stored. Okay, and US government has given guarantee to convert $35 into 1 ounce of gold. Okay, and slowly what happens? The gold price increases. Though there was huge dollar reserve outside US, gold price increases, so people lost confidence in dollar. So what they do? They bring dollar to US, convert it into gold, and bring the gold back to them. So their country. As a result of which, there is a huge gold outflow from US to other countries. So the outflow was gold was very huge. So the gold reserve in US decreases. It comes down to such a level that President Nixon suspended the convertibility of US dollar into gold. They told that we cannot now convert dollar into gold at the price which we have decided, that is equal to $35 is equal to 1 ounce of gold. So US stepped back from the which exchange? Bretton Woods system. But in 1971, US devalued its currency, and major countries revalued its currency, and the gold price was raised from $35 to $38, but the system could not sustain. Again, the $38 US is increased to $42, but still the Bretton Woods system could not sustain, and the countries shifted from Bretton Woods system. They do not accept the the Bretton Woods system. First, the European Union did not accept the Bretton Woods system. Then Japanese countries do not accept the Bretton Woods system. They make their currency free float. Free float. They adopted free float, and the complete breakdown Bretton Woods system was collapsed. Thereafter, another system comes in the world. That system is known as flexible exchange rate. What is flexible exchange rate? Flexible exchange rate is also known as free float exchange rate. What is free float exchange rate? Under free float exchange rate, the exchange rate is decided with the help of demand and supply. Demand and supply, market decides the exchange rate. Exchange rate value is decided for a currency, demand for the currency and supply for the currency. D dash is the demand curve, S dash is the supply curve, and the exchange rate is decided at this point. If demand increases, the exchange rate increases. If demand decreases, the currency value decreases. And this is known as free float system of exchange rate, and this system is designed after the Jamaica Agreement in 1976. So now we will discuss what is the present system scenario of exchange rate in the world. We have discussed the evolution of exchange rate. Now today we will discuss now the present system of exchange rate in the world. Presently in the world there are four types of exchange rate. One is known as fixed exchange rate. Some countries till today are following fixed exchange rate, and there are four varieties of fixed exchange rate. Fixed exchange rate is also known as pegged exchange rate. Fixed exchange rate is known as pegged exchange rate, and there are four varieties of pegged exchange rate. First rate is pegging to a single currency. Second is pegging to a basket of currency. Third one is pegging to SDR. We'll discuss. Next one is currency board arrangement. These are some four varieties of fixed exchange rate. Some countries peg their exchange rate to a single currency, some currency peg it to basket of currency, some currency peg it to SDR, some countries follows currency board arrangement, and some other countries followed floating exchange rate. There are two types of floating exchange rate in the world. One is known as independent floating, and this is known as free float, and another is known as managed floating, or it is known as dirty float. The free float is also known as clean float. Some countries follows clean float, some countries follows dirty float or managed float. We will discuss what is dirty float and managed float. And some countries follows crawling peg, another aspect. It is a compromise between fixed and floating. Next, some countries follows target jode arrangement. These are four type of arrangement systems which are currently prevalent in the world. First, we will discuss fixed exchange rate. So there are four varieties in fixed exchange rate. We will decide one by one. So what is fixed exchange rate? Fixed exchange rate is a system where government of a country decide the exchange rate. Government decided exchange rate is known as fixed exchange rate. So in fixed exchange rate, the government decides the exchange rate. For government, the central bank decides the exchange rate. So it is known as administered exchange rate, or it is known as pegged exchange rate. Fixed exchange rate are of two to four types we have discussed. First, some country fix their exchange rate to a particular currency of another country. Which will be the currency? The currency will be that country's currency with whom you have greatest trading partners. For example, Bhutan is a country which pegged its exchange rate to Indian rupee because Bhutan has largest trading relationship with India. So Bhutan is following peg its exchange rate to Indian rupee. So first fixed exchange rate is pegging a currency to another country's currency. Second one is pegging the currency to a basket of currencies. Before 1993, India was following this system of exchange rate where we peg our currency to five important currencies of the world. Third one is one can peg one's currency to SDR. Pegging means fixing the value. What is SDR? SDR is known as special drawing right. SDR is special drawing right. You can understand it as the currency or unit of IMF. IMF का करेंसी है SDR. You can think it like this. We will discuss in SDR in details later on. So SDR special drawing right. One can settle or peg its exchange rate to SDR. Then next there can be currency board arrangement. What is currency board arrangement? Under currency board arrangement, one board is there, one committee is there. So they will fix an area that is known as monetary area. Okay, monetary area, and within that area they will fix the exchange rate. In this type of arrangement, legislative commitment is there to exchange domestic currency for a specified foreign currency at a fixed exchange rate. This implication is that the money supply in the economy may be affected as a domestic currency can only be issued against foreign currency, eliminating traditional central bank function. So, in currency board arrangement, the domestic currencies, the currency area, within the currency area, the exchange rate remains constant. Constant means some narrow margin of fluctuation is allowed, that is plus or minus 1%. If the fluctuation is to be more than 1%, then you have to take the permission of that currency board. And this sort of arrangement is known as pegged exchange rate with horizontal bands. What is horizontal bands? In this case, band is there. You can fix the exchange rate within the currency area, but within a band. Band may be plus or minus 1%. Next comes the floating exchange rate. What is floating exchange rate? I have already decided. Floating exchange rate is also known as market determined exchange rate. When the exchange rate is decided by the market, it is known as floating exchange rate. In this case, exchange rate is decided by the action and interaction of demand for currency and supply of the currency. D dash is the demand for currency, S dash is the supply of the currency, and the exchange rate is decided at this particular point. If demand increases of a particular currency, its value will increase or appreciate. And if demand decreases of a particular currency, its value will be depreciate. So there will be constant appreciation and depreciation of the currency in relation to other currency on the basis of demand and supply. In this case, the exchange rate fluctuates a lot. The floating exchange rate may be of two types. One is clean float, another is dirty float. In order to understand clean float and dirty float, we have to understand a concept is known as market intervention. What is market intervention? Market intervention simply means buying and selling of currency forex market by the central bank. If in India RBI buy or sell currency, that is known as intervention or market intervention. If under a floating rate system, the market intervention is minimal, negligible, that is known as independent floating. What is independent floating? Under this, the central bank never intervene in forex market. The currency value may increase or decrease, but it will not intervene. It will not buy or sell currency to manipulate its price. If a country is following this, that is known as independent floating. So what is dirty floating? Dirty floating or managed floating? Under managed floating, there is frequent intervention by the central bank under market mechanism system, or there is frequent buying and selling by currency by Reserve Bank of India to fix the exchange rate value within a band, that is known as which managed float. Most of the countries in the world are following managed float system of exchange rate. Only 4-5 big economies are following clean float, like US, UK, Germany. They are following clean float or independent floating system. Next comes another system of exchange rate, that is known as crawling peg. Crawling peg is a compromise between fixed exchange rate and floating exchange rate. In this case, government fix the exchange rate, but after a particular period, it can increase the exchange rate or decrease the exchange rate. If under a fixed exchange rate system, government decrease the exchange rate within after a particular period of time, that is known as devaluation. If it increase the exchange rate, that is known as a revaluation. So if the government can devalue or revalue the exchange rate which is actually fixed, that is known as crawling peg system. Under crawling peg system, there is pegging, but it will be adjusted within a particular period of time. And with the help of crawling peg, any difference between real and nominal exchange rate do not last long. Next comes the target zone arrangement. What is target zone arrangement? In this case, the people form a regional monetary union, like European Monetary Union. They what within that union they fix the exchange rate. This is European Union, and here the exchange rate is fixed. And sometimes they leave their own currency and adopt a common currency. Like European Union has adopted a common currency which is known as Euro. Euro is the common currency adopted under target zone agreements. So we have discussed regarding two types of exchange rate, fixed exchange rate and floating exchange rate. Floating exchange rate is prevalent in the market now. Most of the countries are following floating exchange rate. It may be clean float or dirty float. Under floating exchange rate, there are two important advantages which is not there in fixed exchange rate. In case of floating exchange rate, the exchange rate changes automatically with changes macroeconomic fundamentals. When macroeconomic fundamentals of a country changes, the floating exchange rate automatically changes. If your economy is getting stronger, your currency will appreciate. But under fixed exchange rate, it may or may not happen. Next, under floating exchange rate regime, insulation properties are there. These are two important advantages of flexible or floating exchange rate in comparison to fixed exchange rate. Now we will discuss a concept of IMF and international liquidity. You know that international liquidity is the ability of the country to make international payments. The ability of a country to make international payment is known as international liquidity. After World War II, many countries were facing international liquidity problem. They do not have sufficient reserve currency to make international payment. In order to assist them, one fund is created. That fund is known as International Monetary Fund. So International Monetary Fund is a pool of reserve. The many countries are members of IMF and the members contribute to the fund, and the fund amount collected will be distributed to the member countries who are facing BOP problem or currency problem or international liquidity problem. So, as per article of agreement of IMF, there will be pool of reserves, pool of resources by the members. Each member country has to contribute some money equal to its quota. So you cannot contribute to IMF as much money as you want. You have to contribute, a country has to contribute as per its quota value. The quota of a country depends upon income, foreign trade, etc., macroeconomic fundamentals. One fourth of the quota is to be paid in form of gold, and the rest is to be contributed in its own currency or internationally accepted currency. Okay. So one fourth will be first paid in form of gold. Okay. For about past 2 decades, IMF worked well, but thereafter it is realized that the requirement of the members countries are huge, but the fund balance is low. Because the fund balance is low, IMF created another currency of itself, that is known as SDR or special drawing right. That means now international payments can be done with the help of SDR also. SDR is a currency created by IMF and distributed to its member countries. And member countries can exchange SDR between themselves. SDR is the currency of the IMF. It's a virtual currency of the IMF. Okay, it's the unit of account. And IMF told that if a country want to be members, it has to pay its membership fees and quota. The quota, one fourth of the quota, which was previously to be paid through gold, now can also be paid through SDR. So now one fourth of the quota is paid in form of SDR and the rest in the country's own currency or the currency of internationally accepted other currencies. This is known as IMF and SDR. Next, IMF lending facility. I have told that IMF is created for the purpose of giving loans. To whom? To member countries. Which member countries? The countries which are facing BOP crisis or BOP problem. Any member country which is a member of IMF and he is facing BOP problem or international currency reserve related problem, then he can approach a loan to IMF. So IMF provide loan to mitigate international liquidity problem. So the loans provided by IMF can be classified into following three broad categories. First category is permanent facilities for general balance of payment support. Second one is permanent facility for specific purposes. Third one is special disbursement account facility. These are three important modes through which IMF make loans to the banks, to the countries. Permanent facilities for general balance of payment support, there are two types. One is a reserve tranche facility, another is credit tranche facility. Next, permanent facility for specific purpose can be of four type: EFF loan, CCFF loan, BSFF loan, or SRF loan. Next, the structural disbursement account facility can be of two types: SAF loan and ESFF loan. These are different loans provided by IMF to mitigate international liquidity problem. We will discuss some of the loans. First loan is reserve tranche loan. What is a reserve tranche loan? We know that countries have this, deposit their money in form of quota, and 1/4 of the quota is formed as a reserve tranche, and the country can withdraw their 1/4 of the quota of that is known as a reserve tranche at any time from IMF without providing any reason for it. That is known as reserve tranche. If you want to withdraw money from IMF, you can withdraw easily without giving any explanation to the amount equal to country's reserve tranche. That is a part of quota, normally 1/4 of the quota. Next, if you want more loans than the reserve tranche, you will go for credit tranche. What is credit tranche? In this case, you have to approach the IMF and you have to explain why you require the loan. So the credit tranche will be available in different parts. The first part is first 25%. Without much hustle, one country can get. Rest, if it wants money, then it has to follow the rules, regulations, policies given by IMF. Next, what are the other loans? Other loans is EFF loan. The EFF loan was settled in 1974. EFF loan. And EFF loan extend to 100% of the quota, and cumulatively you can take 300% of the quota of EFF loan. There is another type of loan, that is compensatory financing facility or CFF loan. CFF loan started in 1963. The credit is provided to meet the fluctuation in export earning due to circumstances beyond the control of member government. It can approach CFF loan. There is another stock loan, buffer stock financing. Buffer stock financing was set up in 1969. A country can get buffer stock financing. Next, it can go for SRF loan. What is SRF loan? Supplementary Reserve Facility loan. It is created in December 1997 onwards, and it is available for large short-term financing requirements due to sudden loss of market confidence. A country can go for SAF loan, and this SAF loan, Structural Adjustment Facility loan, it is available. It was set up in 1986. And it is given only to poorest country of the world, and those are IDA member countries. These are poorest country or low income country or least developed countries can get the SAF loan. Then there is enhanced SAF loan. It is provided in addition to SAF loan. This is enhanced SAF loan. It is it starts from 1987, and the loan amount can go to 184% of the quota, 185% of the quota of the country, and this loan is also given to poorest countries, and the loan is interest rate on the loan is very low, just about 0.5%, and maturity is of 10 years. Then there is also contingent credit lines through which IMF provide loans. So IMF does a lot by providing loans to maintain international liquidity. But the benefit of IMF could not be get by lower countries, low developed countries, low income countries, least developed countries. Why? Because of the loan itself, the composition of the loan itself. What is the reason why the benefit of IMF could not be taken by least developed countries, LDCs? First reason is the IMF loan is based upon quota, and the quota of these least developed countries is very low, but their reserve requirement is high. Once the reserve requirement is high, and the quota is low, so they will get loan on the basis of their quota. So it is just a portion of their requirement which they get from IMF. Okay. Next, second one is the second reason why the least developed countries could not get the benefit of IMF, that is the term conditions attached with the credit tranche. The credit tranche comes with certain term conditions or conditionalities. Developing countries lack efficient administrative capacities to follow these rules, regulations, or guidelines provided by IMF. So they could not get the benefit of IMF at the time of their need. So there must be some sort of reforms in IMF loan to have greater international liquidity adjustments. Okay. So we will summarize our discussion today. In our class today, we have discussed international monetary system. It is a system of exchange rate arrangement and international liquidity arrangement between countries. Previously, there was commodity species standard where currencies were made of gold and silver. Gold and silver content decides the exchange rate. Then comes a sophisticated version of commodity species standard, that is gold standard, where there is backing of the central bank to convert the paper currency to gold currency. Once interwar period, there is an imbalance between the international monetary system. Once the interwar period is over, then the fixed exchange rate system was developed and the Bretton Woods system was developed. Under Bretton Woods system, the exchange rate was fixed exchange rate to gold or to US dollar, and ultimately the Bretton Woods system falls in 1973. After that, there is a wide range of system which countries can follow. Some countries followed fixed exchange rate, some countries followed floating exchange rate, some countries followed crawling trade, some countries followed target zone arrangement. And next, the one institute was created to address the international liquidity issues. That institute is known as IMF. IMF address international liquidity through providing loans. The loans can be provided in form of currencies, gold, or the currency created by IMF, that is known as SDR. The member countries get BOP support from IMF under different facilities or different type of loans. The international liquidity has improved over the years, but the low income countries require a greater balance of payment support from IMF, and they share only a part of the cake. They could not get the full benefit of IMF, the reasons we have discussed. The different self-assessment questions are as follows. First, what is gold standard, and explain regarding gold standard, explain regarding fixed parity system of exchange rate and what are the causes of its collapse, how fixed exchange rate is better than floating exchange rate, then what is SDR and how it is improved international liquidity, and what are the different type of loans provided by IMF, and why low income countries could not get desired funds from IMF. What are the reasons? You have to explain the answers. And these are further readings of my class discussion today. Thank you. Thank you for attending my class. Thank you. Thank you all.